Okay, good morning, good afternoon, everybody. My name is Juan. I'm Director of Hotel Intelligence or Hostats. Thank you, everybody for joining us. This amazing panel for this session called The New Normal, New Data, New Insights. We have BD, Business Development Manager for Central and South Asia for STR. We have Roger, Group CEO for RLA, Global Resources for Leisure Assets. We have Rajneesh, CEO of Chalet Hotels, and Matthew, Executive Director and Senior VP of E-Commerce, Distribution, and IT for Swiss Bell Hotel International. Welcome, everybody.
Hello.
Good afternoon. Good morning.
Good
evening, wherever you're joining everyone. From.
Yeah. So we are going to start this session with BD. She's going to show us some insights on global hotel performance and a little bit of what's happening in these times and a little bit of forecast insight.
Thank you. Thanks, Juan. I'm just going to share my screen. Let me know when you see it, please.
We can see now.
Yes, are we okay?
Yes.
Yep.
Great, thank you. Thanks, Juan. And hello, everybody. Good morning, good afternoon to all of you all, wherever you all are. And thank you to InnoFact for having us over here. My name is Vidhi Godiawala, and I'm the Business Development Manager for STR in Central and South Asia, based in India, in Bombay. And for those of you who are not aware, STR is the global leader in providing data benchmarking solutions for the hospitality industry. We work with about 70,000 hotels across 180 countries, with more than 9 million rooms represented on our platform. Now let's move over to see how and where hotel performance is looking like across the world. But before that, might we just take a moment to really acknowledge that the pandemic has resulted in supply shifts for the industry with temporary and permanent closures, which in turn has impacted hotel performance. And STR has actively been tracking hotel closures across the world. Of course, every region closed hotels in the first wave, and some dips, as you see here, across markets in the second quarter of this year were all due to the second waves that hit these respective regions. But now supply appears to be back to normal, with the US clearly seen to have hotels open throughout the pandemic. A slightly closer look in Asia Pacific, where the story is slightly different. There has been a larger variance in temporary closures. Now, the teal line on your screen is what was closed during the pandemic, and the blue bar is representing what still remains closed. And when we look across some of these markets, in blue, it's mostly the Maldives, Singapore, China, Australia, Japan, where majority of the hotels have opened. But still, there are some big numbers closed as a percentage of overall sample, as we see in Myanmar and Thailand and Vietnam, of course, due to the Delta and the restrictions and the closure of some of these countries and markets. The last quarter, moving on to the global performance, hotel performance overview, the last quarter has really been all about vaccines and the Delta waves, which splashed across different regions at different times, which has impacted hotel performance accordingly. Vaccines have been widely available throughout all of Europe, the Middle East, and the United States, and this has allowed these regions to really reduce or eliminate COVID-19 restrictions, which in turn has helped jumpstart recovery and drive some of the summer leisure demand, especially in Europe and the USA, as you can see. Now, most of the Asia-Pacific region continues to lag in the vaccine distribution, but hotels in China have seen extraordinary growth in the second quarter, in fact, beating 2019 profitability levels now for a few months in that quarter too. And as you can see, China is bouncing back after the Guangzhou Delta outbreak that happened about six weeks ago. And there is a variance, as I mentioned, in recovery in vaccine rates in Asia Pacific, which has led to an uneven recovery in tourism for the region as well, when you compare it with Europe and the Middle East. But then as the summer months come to a close and school holidays end, Europe, as you can see, is seen dipping or rather slipping, and so is the Middle East after gaining momentum in May and June after the Ramadan and Eid festivals. Now, profitability levels for hotels have begun to recover in many regions. North America, as you can see, Europe, the Middle East in green, and in Asia, we have Australia, China, of course, and India too, really coming back in the black. Many Southeast Asian markets continue to struggle with caseloads and restrictions. Now, when you look at the gross operating profit per available rooms, there is a gradual upward shift. And what's on your screen is STR's monthly profit and loss data, where we collect and report monthly data for hotels from across the globe. Your GOPAR levels are, as you can see, commensurate to the demand that's seen in each region. And the slide that I just presented to the 2-3 slides before this, where hotels in the US, which have been open throughout the pandemic, have seen GOPAR levels increase steadily and reach almost 82% to 2019 levels. In fact, Europe too was fast to catch up, as you can see, soon after the restrictions eased in May and June this year. The Middle East continues to plateau, and some markets in Asia Pacific dragging profitability down. But it's actually the Maldives, which is one market in Asia Pacific, which has raced ahead in profitability. And at a year-to-date level, the total revenue per available rooms indexed to 2019, it actually shows hotels in the Maldives sitting right on top of key international markets globally, surpassing some really strong markets like Shanghai and Beijing. In fact, the YTD GOPAR levels too in the Maldives is already at 92% to 2019 levels. And in just a bit, we'll see really how recovery for that market has been shaping up too. And hotels in some other Asian markets such as Singapore, New Delhi, Tokyo, and Sydney trying to play catch up in the TRevPAR levels. Bali and Bangkok sitting at the bottom given the restrictions and the caseloads. And a very similar story there, even for the GOPAR and GOP margins. What you see on your screens, the chart on the left shows July 2019 numbers, and on your right is July 2021. Now you see GOPAR on the y-axis and the GOP margin on the x-axis for some of these key Asian markets. And most markets are doing fairly well, similar to the TRevPAR levels, but we saw Singapore, Beijing, Tokyo, Shanghai, New Delhi, and of course, the Maldives. But again, it's the hotels in Bali, Kuala Lumpur, Bangkok, dragging down profitability for general and broader APAC, given the border closure and the recent spike in COVID cases. Now, moving on to really talking about the top line performance for some of the key Asian markets, we've seen many and great encouraging stories across APAC. And I may not have time to really touch upon all of these markets and stories, but let's really look at some of the more defining ones and see how hotel performance has been shaping up across Asia Pacific. China as a market has moved a lot in the last few months. In fact, it's gone through many ups and downs. And then in the Q1 was a little bit of a disappointment for China, with Q2 really moving in the right direction and performing and coming back really strong. But China in the most recent months, the recovery pattern, as you see, has been much swifter. After the Delta outbreak that happened, the lighter green line, which is China, bouncing back much quickly, whereas Australia is a lot more extended in comparison. Summer months were also quite good for China. Luxury, upper upscale, the higher class hotels in China performing fairly well, and things continue to move forward, of course, with restrictions depending on new outbreaks coming through in different regions, as most recently seen in some of the districts in China. Another market with a good recovery story is Hong Kong. And demand has steadily been increasing in 2021, crossing 60% with most hotels open. Borders, although remain closed from mainland China, so they remained unaffected from the Guangdong outbreak. But then that meant that F&B and retail ends up being restricted, which was then coming from mainland China. Now, of course, the comparison for Hong Kong will always be for 2018 for most people who are really benchmarking this market, which was really the peak for Hong Kong and not 2019, given, as most of you all would remember, the geopolitical challenges that came about in 2019, where performance was already lowered But levels are, as you can see, already touching 2019 in Hong Kong with consistent demand pickup for the market. But it's a slightly different story here in the Pacific, given the unfortunate turn of events. The Delta variant has impacted hotel performance for this region with restrictions and lockdowns as at different times for different states. Performance, as you can see, was going fairly steady and quite strong, in fact, towards the end of 2020, entering 2021 fairly well as well. But occupancy started trailing over the course of 2021. This, of course, was a result of the Delta outbreak and the exposure that some of the international cities like Sydney and Melbourne had towards the international markets. But occupancy, and as you can see towards the end of the graph, the Delta takes over not only Australia, but also New Zealand and that market, which had no COVID, but unfortunately got affected. And then the government took actions to lock down, and then there was an impact to that as well. But another encouraging sign and a story of quicker recovery that we're seeing is in India, and occupancy levels for all India hit rock bottom to 11% during the first wave of the pandemic in 2020, and 20% during the second wave in April this year. Now, it took about 10 months, as you can see over here on your screen, for all India occupancy levels to climb 50% from the low last year. But it took only 2 months to really achieve this milestone in the second phase of the recovery. And what we're seeing, this is the pattern in many of the other global regions as well, where the second wave recovery has been much quicker than the first wave, as more and more hotels and the industry adapts to the vagaries of the pandemic and evolves in terms of reacting to that in a much swifter manner. Similar story is in the Maldives, where recovery, and as we already saw, that profitability levels for the Maldives has been fairly strong in 2021. The recovery has been much quicker in the second phase. It's also, of course, worth mentioning that for the Maldives, supply has been growing at a faster pace than demand, but the gap reduced towards the end of 2019 for the Maldives. However, when we include 2020 and 2021, you can now see clearly the impact of the pandemic and that clear V-shaped recovery that is encouraging and similar to what we've seen in India and in China and some other markets too. A quick mention on some of the Southeast Asian markets. Not much has really changed in the last 6 weeks. The only story or country to show some encouraging signs and momentum picking up is Indonesia. Indonesia too, like India, saw its share of the Delta variant and the humanitarian crisis really impact the country. But now things have improved and demand has begun picking up with visible weekend spikes. As you can see, vaccination rates are high in Jakarta, with almost 90% done with the first dose in the capital city. Indonesia is also now getting the other international vaccines like Pfizer and AstraZeneca. So the pace of vaccination continues to pick up over there. Bars and restaurants too are opening up in Jakarta and Bali. But if you look at the other markets like Philippines and Vietnam and Thailand and Malaysia, they still remain muted given the Delta still continues to add cases and restrictions in these regions. But as you can see, Singapore too has some weekend spikes, which seem weekend staycation spikes, which seem steady throughout. Now, let's move on to looking at some of the forward data. STR reports business on the books data of forward occupancy for 85 markets worldwide, and we continue to launch more markets globally. Which really means crystal ball gazing no more, and the data helps you make these revenue management decisions. And the chart on your screen now shows how occupancy on the books for the next 90 days is looking like for some of these Asia Pacific markets, and also thrown in London and Dubai there for comparison. Bangkok continues to see a flat line, very commensurate to what its historic performance was looking like. Sydney picks up slightly on the weekend, as you can see some of the weekend spikes towards November, but it's pretty much flatline until then. Short-term bookings in Singapore look strong, but levels are down in the longer tenure. And the London market sees consistent weekend spike right up till the end of the year, in fact, and Dubai trading at a consistent 30% throughout, falling off at the very tail end. The Maldives, of course, which has been the star performer, has more than 50% of occupancy on the books for the next 90 days. And this is significantly higher to the same period compared to last year. The Maldives is one of the few, in fact, markets that's seeing consistent positive pickup, which means no cancellations, and the lead times are much longer in comparison. In fact, as you see, winters for the Maldives are shaping up pretty well as well. And as we move over to the Pacific, and when we look at forward occupancy data, the short-term future is looking slightly weak. Sydney and Melbourne see negative pickup, and pickup for Adelaide is seeing more for short-term window bookings. Sydney and Melbourne see a lot more impact given their exposure to international markets and hence their exposure to the Delta variant. And as a result, in fact, future bookings for other regional Australian markets too has plummeted, given both Sydney and Melbourne serve as a strong source market for some of those leisure regions in Australia. But then, of course, there is some amount of traction that we've also been seeing in our data in December, especially for the Ashes series, where demand is already sitting at about 70% in Adelaide. Sorry about the background noise that's coming through. Apologies. And I'll be done very quickly in the next two slides. We're talking about forecasts, and STR does report forecasts for many global markets in collaboration with Tourism Economics, which is a division of Oxford Economics. And of course, predicting the future has never really been easy, tougher in the last couple of months, the last 18 months. But when we really look at some of the key metros in Asia Pacific, Shanghai is clearly steering ahead in the 2019 demand index. Although for most of the forecast predictions, the growth lines, as you can see, have moved slightly further to the right, mostly because of what's happening with the Delta and what we've just spoken about. Now, once performance starts improving and the market reaches up, quickly, it is really the tail end of the recovery that takes a little longer. And for some markets, it's the dependency on international markets that matters a lot, like we have for Bangkok in this particular slide. And on the rates front, it's a slightly different picture other than Shanghai, where ADR index is expected to reach 2019 levels in 2022. For the other regions, this is forecasted to reach only in 2025 or even later. So thank you, and handing it over back to Juan.
Thank you, Bidhi. Thank you very much. Any of the panelists, do you have any questions for Bidhi, or do you have any comments? Roger, Matthew, Rajneesh, any questions there?
No, I just have one comment that, just by going by that V-shaped graph, that it has condensed to 2 months now, the pickup in our market, especially India. Very encouraging to see that. And also it kind of reinforces the belief of many that people are learning to live with COVID. Not that they're happy about it, but I think the knowledge that we all have today as a collective group of people has increased. The fear quotient has gone down slightly. And the vaccination efforts of governments, wherever it is intense, has definitely helped our industry get back to our feet. We're still not running. We're taking baby steps, but I think it's very encouraging to see that. So thank you, Bidhi, for displaying that data. It really gave us a good morning dose to see that.
Yeah, no, I would totally agree. I think there's every reason for the hospitality industry and tourism to be optimistic. Throw in a caution, a sprinkle of caution there, of course, where the Delta variant, vaccination levels, political decision making opens and closes borders from one day to the next. But we can see quite easily that there is optimism, and people want to travel. And the market, tourism responds extremely aggressive. And we saw that even with British Airways shares. What happened after the announcement that transatlantic flights will reopen again in November. So tourism is back, I believe. Back to you, Juan.
And do you guys think like tourism will come back? International traveling is just waiting, excited to travel again. But all these people that have been traveling domestically these days and really enjoying their own country, are they going to keep traveling within their own countries for the next couple of years instead of going abroad? What do you think of that?
Go ahead, Roger.
So, yeah, okay. I think it's a very good question. I think it's one of economics, price point that will have a huge influence on whether we continue, enjoying our local experiences, holidaying or jumping on a plane. And I think if once we get back to pre-COVID levels with accessibility for airlift availability, price points that were relatively cheap, that will be a game changer again for tourists who I think want to travel beyond their shores once again. I think we've got used to being able to travel around the world, and that won't change.
Yep. Just on that one, I agree there. When we saw the Trans-Tasman bubble open between Australia and New Zealand, for the New Zealand tourist hotels, we did see a substantial uplift from bookings coming from Australia. Unfortunately, it dropped off the planet again, but we did see that desire to travel overseas.
Yeah, but can I add to that? I agree with both Roger and Matthew on the desire to travel and the drivers behind the international travel going up, which obviously is accessibility, price points, etc. There's another input on that I have. It also depends on the domestic players, how they have encashed on this opportunity which came along their way. By international travel being completely halted, all of us have an inherent desire to travel. I mean, there's no denying that. People do need holidays, they do need to travel. So if like I'm in Mumbai, so around Mumbai, there are several, people have been traveling only within the country right now. So it's also how these domestic players or hotels in destinations within the domestic circuit have been able to upgrade or uplift their facilities and offer people a good alternative, even in the future when accessibility is no longer an issue or travel is not restricted. Even then, to choose domestic destinations could depend on how these domestic destinations shape up, during this period.
Yeah. Okay. So let's move on. I will share my screen now. I'm going to show some slides on performance. Okay. So I'm going to show some figures, some data from Hostat. We do hotel benchmarking on a monthly basis and for the full P&L, not only top line but also expenses, payroll, all the way down to GOP, right? So I'm going to show a few slides on this regard. So for example, first one is GOP per available room, and this is an interesting slide. This is the variance over 2 years period. Each point is over a 2-year period, and it's from January 2020 to August 2021. So this January 2020 variance in GOP per available room is versus January 2018, right? Whether this one this variant in August 2021 is versus August 2019, which is just before the pandemic, right? So we see it's interesting because the trend was going in the right direction, but then since July, we've seen a drop especially in Asia Pacific. It's been the biggest one, and mainly because of this new variant, right? It's a pity. We were going all in the right direction, but all of a sudden things are not moving very favorable in the last 2-3 months. Let's see how the forecast is for that. Then this is again in GOP per available room. It's in US dollars, and this is comparing some of the main markets globally, 2021 versus 2020 year-to-date figures, right? So yeah, I mean, again, we can see that Asia Pacific is the one that is really hitting the worst, right? Like, although China is ahead, but then, yeah, we see like UK, Thailand is really suffering from all this, Singapore, Vietnam, right, versus all the other markets like the US, Australia, Saudi Arabia. So yeah, it's interesting to see like how this variant has hit Asia Pacific. Maybe also related to the maybe we can discuss this later. How is all these figures affected by the vaccine rollout programs in different parts of the world? Then this, and now it's a little bit more in detail for key cities, right? Again, same trend for each of the cities in the countries I just showed earlier, but interesting to see like Beijing, for example, really doing great versus Bangkok performing really badly, and Da Nang, Hong Kong is performing better, Singapore still not there, Sydney still not there. So it's very interesting to see how different cities are performing in terms of GOP. And I put this slide because it's interesting, and this could be a good topic to discuss as well. Like we saw earlier during the pandemic that luxury got a really big hit, and then we see it has recovered like faster, and it's all the way up here already to all the other asset class, right? So this is a very interesting. I was always very curious because I was always thinking that luxury would remain during the pandemic, but it proved me wrong. But then now it's all the way back again on top, right? So yeah, I'll give you some time later to make some comments on this. What do you think of the different asset class performance during this pandemic and the forecast? And then I'm going to show a couple of cost lines. For example, total labor cost per available room. And this is again comparing the main regions, Europe, US, Middle East, and Asia Pacific. And it's just again to see how bad it was when the crisis started, and then slowly recovering, very slowly for all the different regions, right? Another interesting point would be the total hotel expenses per available room. We see like again the big drop when all the pandemic started, and then all the markets, this is all positive news, slowly coming back. So yeah, this is, yeah, all the markets are showing positive sign here of hotel expenses coming back, which is good. And then I have here this is an interesting one. This is showing by room cost by type, and yeah, it's a little bit the story of this pandemic, right? Like we have seen like cleaning supplies and housekeeping labor increasing massively because of all the requirements on health issues, but then other departments clearly underperforming mostly. I mean, this cost per bookings and all that, mainly because of the ADR dropping significantly, right? So very interesting to see all the different costs, how they have reacted to the pandemic from different perspectives. And then this is for undistributed department, undistributed expenses. I'm comparing here China with Middle East as a sample, but we can see that they have all more or less followed the same trend for the total overhead. Yeah, this is 2021 versus 2020 and 2019. And we see like the trend is very similar, right? Where it was massive in 2019, then the big drop in 2020, and now they are slowly recovering and slowly getting to 2019 levels. for maintenance, for sales and marketing, for admin and general. They are slowly getting to 2019 level, which is good news, I guess. I mean, they are costs, but it's good news, I guess, to see like they are matching. That means that hotels are betting on those costs, matching revenue, which will be there, matching 19 figures as well, right? So this is, yeah, these are few slides. I wanted to keep it short. I wanted to show a few cost lines. And yes, I would like your comments. Do you have any comments in any of these specific slides? Maybe in this, yeah.
I noticed cost per booking going down by 15% in one of your slides. You know, I think in our market, we've seen them go up slightly because of the shift to the online OTAs largely contributing to a significant portion of hotels' businesses today. So it is driven up. So I was wondering what is driving that down by 15%?
Sorry, what slide were you in? Sorry,
there was a slide of costs and
yes.
like housekeeping, which had gone up by 48%. On the same slide,
yes.
there was cost booking, which had come down by 15%.
Yes.
So I just wanted to check with everybody else on the panel if anybody is on the inside of that. Within our market,
I think that cost per booking, I think, is mostly driven by the direct booking cost. I mean, those are impacted by the lower ADR, right? So the cost per bookings are normally percentage over the room revenues, right? Mm-hmm. So lower ADR. Yeah.
That clarifies. Yeah. Because cost
we've seen our direct bookings grow.
You know, that's why. Okay, got it. Thank you.
And then what do you guys? I'm curious to see what you think about these asset class performance. How luxury really performed poorly during the pandemic and now is back again. What do you guys think about that?
I'm amazed by that, but though. For the luxury assets, I'm still wondering how that, because I would say the greatest percentage of our hotels are in the 3- and 4-star range, and the gross profit per room is certainly lower than it was in 2019, but it is coming back. The luxury hotels that I see in Bali have still got massive price cuts because the occupancy is pretty low there, but people are going to those first because it's for many people now they can afford luxury hotels.
Yeah, they feel safer as well because of
Yeah, I think it's definitely because the luxury product is much more robust. Thankfully, due to they've got more flexibility with the rates. You've already touched on Matthew there. The rate discounts there, so they've got much more room to play in terms of how they can be competitive in the market, and that gives them a significant advantage over the lower class asset classes. I would be curious actually, just in terms of I know you mentioned the one that the operational costs throughout, undistributed payroll are all coming back, quite quickly. Yeah. I'm curious when we get into, 2022 and we look back, I have a sneaky suspicion that they will stay, somewhere in the region of 10% lower than what they were pre-COVID. I think there is every, incentive and experience now from the hotel operator and hotel owners in terms of managing costs better and being much more efficient. I don't know what put this to the panel. Do you have a similar opinion, or do you think they're just going to come back to normality, to pre-COVID levels?
I think we operate upper upscale and luxury hotels at Chalet. So not operate, we own. So rather, I think some of the costs, during this past 18 months. I think every hotel company which is worth its salt has analyzed everything that is doing under the scanner. So a lot of costs which were earlier not really focused on because they were too small have suddenly appeared big because the revenues have gone down. So then you see those graphs popping up in your monthly MIS reviews with the hotels, and you get involved in costs which you were never involved earlier as asset managers or hotel owners or even operators as such. Now that gave us time to reflect on those costs. A lot of them were unnecessary, and I would call them weeds growing in a field. And some of them went unnoticed earlier because we were not worried too much. But now, since the money was scarce, we were worried, and some of the costs are going to stay low. So I think a lot of good companies would have reduced their fixed cost structures by a significant proportion, I would say. I mean, and the investment that has gone into technology could be permanent replacement of certain processes run by manual processes, will also help reduce labor costs. The focus on ESG or the awareness of the environment, the energy consumption, etc., and the capex investments that is going into, at least in our part of the world, I can talk about. A lot of good companies are making capex investments into improving energy efficiency as well as employee productivity. I think overall the costs are heading lower. Our industry would have transitioned into a more efficient business model going forward. I feel.
Yeah, I agree into that. I have a question from Kamal saying that if the drop in reception costs, the reception department is due to labor shortage or because of guest-facing on-site technology replaced, right? I think it's mostly because of labor at this point. I don't think, I mean, we're seeing a lot of hotels catching up in all this technology and for the check-in and everything, but at this point, the main driver, I think, is less occupancy, less staff, basically, right? Like less staff in receptions. I think that's the main driver today. Although, yes, I guess replacing receptionists by technology and online checking and everything it's happening, and it will happen more and more. But what we see today, the impact we see today, I think it's mostly on staff, less staff, basically. What do you guys think of that?
Agreed.
Yeah. And I mean, from my perspective, for our group, we're still being very conservative on the rehiring of staff. We've seen how things have changed and things have increased. But from our perspective, we're still not quite sure what the new normal is yet, and what can change. So we're being quite conservative on rehiring and then basically what's required, yes, but other than that, not yet.
Yes, another question in this regard, like, how do you guys see like new normal will accelerate the hotel digitalization? I mean, we've seen it happening already, but
yeah,
I think we are not there yet, right? When do you think this? I mean, it's accelerated by, it's being forced to be accelerated, but when do you guys see like a good digitalization level of hotels?
I think it's
sorry, go ahead.
Okay. Okay, thank you. I think it's always in the hotel industry, it's all about interface. It has always been the challenge, that we've faced, and it's a question of how efficiently, how quickly we can get all of the key interfaces talking to each other. Whether it's from browsing to online booking, from flexibility on packages, room rates whilst in that space, to the information that needs to be gathered about the hotel guest and what they want at the trip, and that the hotel operator can actually see that information. And then from a yield management point of view, those in the asset management room can actually see this information up to the second and not looking at it, 1 week after the guest has arrived. And I think that interface needs to be faster, much faster. We see the technology industry, leading it, whether it's the Apples, the Googles of the world, the Amazons of the world. They know what their guest wants immediately when they ask, not some minutes later. And I think that interface, it's a question of interface and getting that to work efficiently, quickly. That's my opinion on it. Back to you, Juan.
Yeah. Rajneesh, did you want to add something?
Yes, apart from the, I think the speed of adoption of technology was not that fast in the hotel industry. That's why even the tech companies were not investing that much into developing technologies for the hotels. But this pandemic has kind of pushed that need real hard. And the hotel industry has realized that adoption of technology is helpful in every way. So it has speeded the process. And more tech players are getting into technology that can make life better for hoteliers as well as its customers/guests. So I think we would see adoption going at a much faster rate, and we'll catch up with the other industries which adopted technology very quickly and have like banking, insurance, etc. They all adopted technology a few years back. Hotels have still been slow because we vehemently defend our need to have human interface. Of course, it is part of our industry. It can never go away completely. But I think we hoteliers have been safeguarding it a bit too much and trying and a bit reluctant to adopt technology, which is now gone. And I think everybody wants to embrace it faster because they realize the potential it has to unlock various things.
Yeah, but that approach in terms, and I think it was wrong of the industry to think that, we are hospitality, we do need, to be greeting, and we need to keep that personalized experience. And that was taken as an opinion throughout the industry. And that, I think, was very naive. It wasn't looking at the guests that you serve in each individual hotel and say, what do they want? What do they prefer? Because if they'd understood answering that question, then they, I think, would have come quickly to realize that it is horses for courses. And some guests do not necessarily want to have a reception. Some guests just want to get to their room as quickly as possible. I don't need that meet and greet at the reception that says, how are you today, sir? Did you have a good flight? I've just had that hotel check-in at the airport check-in. I don't need it at the hotel. So how do you, serve and personalize the experience to the guests that you are catering to?
Yeah. And we are almost at the end of the session. Roger, you wanted to share some thoughts on wellness.
Yeah, we have a little bit of time. I mean, I can share 2 slides if we have enough time for that.
Yes.
Okay, I'll be very, 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 very quick. This is, and the reason why I will be quick is because this report can be downloaded from wellnessrealestatereport.com and free of charge. This is a report that we annually produce where we are looking specifically how we can assist owners, developers, investors, and operators in understanding how wellness, leisure activities influence property level performance using traditional KPIs. And what we've done is defined a segmentation within the properties we've looked at, which is over 3,200 worldwide, to compare data. And the way we've done that is that we've looked at using the uniform systems of accounts and looking at the assignment of leisure and wellness revenue streams. And we've segmented property that generate more than $1 million and 10% of total revenues derived from wellness and leisure, and classified them as major wellness. Minor is classified as those generating less than $1 million annually and less than 10%. And we also have no wellness, which equates to no tangible revenue from wellness. And what the key data reveals is really, what we've been singing about for the last few months is that, leisure has really led the recovery of the hotel industry, arguably. And during the pandemic, what we've seen is that those properties with, significant wellness and leisure experiences have been able to drive significantly more and better ADR rates, TrevPAR and TrevPOR throughout the globe. And that's on the top line. I'm trying to keep this very, very brief because the report can be loaded. So on one side, it seems that, wellness and leisure does have a significant influence in catering to the leisure experience. and the leisure guest. But when we've looked at the bottom line and we look at GOP levels, I think this is where it gets interesting, because what you see is minor wellness has a better GOP level, almost 4 percentage points, depending on where you're looking there, particularly if you're looking at GOP. And what that really equates to is, particularly for investors and developers, that they do have to be very, conscious of if investing into leisure and wellness, that they really do need to be aware of the amount of real estate that they and the capex that they're going to dedicate to leisure and wellness, because it doesn't necessarily mean that you're going to derive a more attractive IRR, because arguably, if we was to correlate the GOP and kind of run an IRR exercise on each property and comparing major and minor wellness properties, we would probably see a better IRR rate with minor wellness real estate. That being said, that's from an investor's point of view. Leisure has led the way and will continue in the near future, but we just have to be conscientious of what constitutes leisure and wellness and the activities that will influence the ADR levels, and by how much, and how much of an investment is it going to take in order to justify that growth. I'm not going to say any more on that because the report can be downloaded. I wanted to be brief. Back to you, Juan.
Okay, thank you, Roger. No, but it's a very interesting point. It's a very, it's driving. It's clearly driving the market, right? I have another question that just came for you guys. Like, how do you think millennial travelers are important in today's time? Like, the emphasis on experiences and dining at restaurants has become like much more of a social experience than with the past generations, and the industry and the lockdown. Can it impact the business?
Most certainly, yes. More than just the, I would not restrict the millennials to just the age. I would also talk about the millennial mindset, which many older people are adopting now, influenced by these actual millennials. So I think they are an important segment, which is just the millennials and the millennial mindset. Together, I think they are the biggest customer base that exists today. And I think every hotelier or hospitality company needs to be aware of that and need to be top of the trends of this particular mindset to stay in business. In fact, going forward, it will be as important.
Yeah. I mean, just for me to add there, I mean, let's face it, millennials are now 40 years old. They're in the spending prime.
Yeah, but even younger generations are millennial, right? Like they are there, they are traveling, they are going to restaurants and being social, and we definitely, hotels definitely have to consider them, right? Like,
yeah. You have to consider them, but again, what we tend to see as an advisory so many times is that hotels, try to appeal to, too broad a range of guests, and try to be, a jack of all trades and a master of none, and trends come and go. And so, it really is important to understand, who your guest is and how you can better serve them and stay in your lane. And that can preserve your market positioning. It can make you more compelling, more competitive. It preserves your rates, and it preserves a returning guest. And we've seen that time and time again. It's just that, trends come and go. And what we see is, hotels trying to keep, an appeal to every Tom, Dick, and Harry, so to speak. And that's dangerous.
Yeah, it is. That could annoy, or those millennial customers could annoy any other type of customers that are maybe they have been your main business in the past and they will not return. And as you said, if the trend changes, you're out of business a little bit, no?
Yeah. Just to add there, you know, traditional feasibility studies always kind of look at benchmarking properties, and that's becoming somewhat outdated model now, because you really need to understand the profile of the guest and benchmark where the guest is spending money. You know, what are the experience, what are the brands, you know, they are leaving their dollars. And the better you understand that, the better you can get closer to understanding, you know, how do you appeal to them and what experience you need to offer in your property.
Yeah. Okay, I think this could be the end of the session. Do any of you have any final thought or anything you want to add? No. Okay, so thank you very much for joining, and have a great day, and see you soon.
Thank you.
Bye-bye.
Thank you, Juan. Thank you,
Bye-bye.
Thank you, Matthew. Bye-bye.
Thank you.